Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you stay ahead. Joining the show today for a discussion on where they're finding growth opportunities as we enter the fourth quarter are Fidelity U.S. Growth Opportunities Class portfolio managers Kyle Weaver and Rebecca Baker. Kyle and Rebecca focus on identifying long-term growth opportunities, even in controversial or volatile market conditions. Their investment approach often revolves around understanding secular growth trends like AI and e-commerce, and finding the right business models to capitalize on them. Kyle and Rebecca underscore the complexity of investing in large themes like AI and the importance of selecting the right companies with sustainable business models. They explain how past technological shifts, like in wireless data, provide valuable lessons for navigating AI investment. Their discussion with host Pamela Ritchie also touches on other sectors where they're seeing opportunities, like solar energy, which could be influenced by political outcomes, industrial companies that stand to benefit from AI innovations, and used car retail, which is being transformed by online research and e-commerce growth. Kyle and Rebecca advocate for a balanced approach, where long-term growth themes are assessed alongside short-term cyclical factors to optimize their investment strategies. Take a listen. This podcast was recorded on October 2nd, 2024.
So let's go straight to the discussion of interest rate cuts. Every day there's data. There's more data today. Kind of unexpected. Hard to know whether that swings anything one way or the other. But what we kind of knew is that September was going to bring probably a paradigm shift and rate cuts would begin in the United States. That did happen. What did you do leading up to that? I'm presuming you saw it coming as well. I'll put that to
I think it's a great point. These rate cuts were widely expected and we're happy to see them starting. But I mean, taking a step back, one of the things that Kyle and I are always looking for is companies with good long-term growth opportunities. So a couple of companies or a couple of end markets that we found interesting are auto-exposed semiconductors, marketplaces that allow consumers to buy cars, housing-related stocks, so whether that's home improvement stores or companies that sell building products to new home builders. So these are industries where we see long-term secular tailwinds. You know, the housing stock has been underbuilt, homes are getting older, so we need to see investment in that area. Sort of similarly in autos, EVs have much more semiconductor content than ICE vehicles. So as we see a shift toward EVs, we see a lot of growth in that industry. And then buying a car is still sort of an outdated process in a lot of ways. And so we see disruption in the way that people buy cars. And so these are the types of stocks that we like to try to buy with a long-term view. But often some of those positives, the secular tailwinds that I discussed, are pretty well understood by the market, and the stocks can be priced for perfection. So when we see volatility in the stocks created by rising interest rates or disruption during COVID, we try to take advantage of that. And I would say that's exactly where we were a year ago. You know, rates were high and rising. Consumers were under pressure. They were not buying cars. We were not seeing housing turnover. Housing turnover was back at levels that we saw in the GFC. And so we saw a really attractive entry point in some of these long-term winners. And so I think we were adding to them even before we had confidence in rate cuts. And now, obviously, the fact that we've started seeing rate cuts is going to be an incremental tailwind.
Fascinating. Thank you. And I feel like we'll circle back because there's quite a lot of, I want to dig into some of the assumptions that you have and how you look at the consumer actually based on some of the things you just mentioned there. Kyle, I might just ask you to touchstone us back to the fund itself, U.S. growth. We kind of know what it says in the title of the fund, but what is it meant to do, your fund?
Oh, good question. So the fund is meant to invest in stocks that are very cheap on a 3 to 7 year basis, usually by growing into that valuation. They might start out looking very expensive or unprofitable. There are some that we always try to find that are less expensive on current year earnings, but the common theme across all of the stocks we pick to put in the fund is that we think they'll be very cheap on a 3 to 7 year view. And hopefully we can, and can continue compounding earnings and free cash flow after that. And then the second thing that the fund does is try to take advantage of volatility in the market. And that's where, back to what Becky was talking about, over the last couple of years, as interest rates, went had their largest increase, I think, percentage increase, like in U.S. history, at least in the last many decades. Big opportunities arose in some of the, in secular growth stories, which we like and we're always trying to find, that were experiencing their first real severe down cycle in their end markets, whether that was, in used car retailing or home improvement or different other kind of cyclical parts of the economy.
Right.
Well, Becky and I don't really have we don't go out and we don't think we have a differentiated view on the macro, but, we look at our companies on a bottoms up basis and are aware of the sort of mini macros that are impacting the business models, whether that's in, digital advertising, e-commerce, different parts of the retail economy.
And do you bucket those, Kyle, into, I recall when we've spoken in the past, and I forget the names of the buckets, but how do you sort of put those
the buckets? Yeah. And so, we try to, in addition to all the other sort of risk factors and overlays that we look at, qualitatively, we want to have some exposure to 3 different kinds of stocks. And, the bread and butter of the fund are the strong long-term growers, or the blue chip growth stocks, which are basically the index components of the Russell 1000 Growth Index. They're recognized by the market, but there can sometimes be good opportunities in those names when there's a transitory issue and some names fall out of favor. So we take our bets in sort of the bread and butter there. The largest component of maybe differentiation for the fund over the past many years has been in the breakthrough growth bucket, we call it. And those are names that are not currently recognized as strong long-term growers because they may be too small. They may not have the track record yet. Their earnings potential may be masked by investments that they're making to grow the business. And that's where some of the fund's winners over time have really come from. Like Tesla is a huge index component now, but when it started out, when we were invested in it 10 years ago, it was a money-losing, highly speculative, very controversial name that would have gone in that breakthrough growth bucket.
Right.
And then balancing those out are the names that a value fund manager might own, but we think are actually legitimate growth names also, and we call that the resilient growth bucket. And that's where, a lot of the ideas Becky was talking about might have fit into that category. These could be, analog semiconductor companies that the market is treating as pure cyclicals, but that actually have very good, strong, long-term secular growth drivers that are just being masked by the mini cycles that they're working through in the end markets that they're in.
That's fascinating. I mean, everything you're saying right now makes me want to ask about AI. So I'm going to ask about AI.
Can I just, the common theme I want the investors in the fund to understand is that whichever bucket you're in, Becky and I think that that company is cheap on a 3 to 7 year view. It's, the breakthrough growth bucket has a lot more work to do to get cheap generally than the resilient growth bucket, which is already often, quite reasonably valued on near-term metrics. But our key stock selection criteria is cheap on a 3 to 7 year view.
Brilliant. So within the discussion of AI, which has had a remarkable story to tell this year, I mean, you can almost feel people are going to be sort of documenting how this year has been. Becky, would you say there is an element of that sort of longer term? Obviously, we seem to be talking about something that's going to be with us and reshaping us for a long, long time, but there's also kind of a cyclical element there as well. Can you put those together? We might circle back to that, but it strikes me it fits with what you're saying.
Yeah, definitely. I think AI is a very important long-term theme. And I think this really captured people's attention probably 2 years ago at this point with the really impressive user growth that OpenAI saw after the release of ChatGPT. And then more recently, we've seen more companies chasing after a similar opportunity in AI. And what that has meant is a lot of purchasing of semiconductors and more broadly AI infrastructure by the largest companies in the world, because they want to make sure that they're ready to either incorporate AI in their products or use AI in the background to make their products better. And so that's what's driven the success of NVIDIA. And as you said, I think there's some concern out there, both that we could be in an AI bubble because this user growth and this investment has come so quickly, and because we've seen other bubbles in the past. But I think we're really optimistic with a long-term view that that AI is real and it can drive productivity for workers. It can drive better experiences for users. And that a lot of the companies that we're invested in are really well positioned to benefit. The earliest data points that we saw in terms of return on investment by the largest companies pursuing AI are stocks like Meta, that is using AI to power their recommendation engines. And that's driven increasing user engagement because they're showing users more relevant videos. And it's driven better monetization as well because they can place ads better. So that's one early data point, but there are so many more that make us optimistic that AI is real and that the big companies are going to keep investing behind it over the next couple of years.
Kyle, what do you sort of say to that as well with the idea that there's been, there are these strong long-term growth that probably would fit into that bucket for you, but there's also a cyclical story here, it seems.
Well, sure. And I'm not sure whether this is exactly where you wanted me to go for it, but some of the names that we've invested in the AI space, especially in the semiconductor space, also have parts of their business that are currently cyclically depressed because of other end markets. And so like a name that we found last year that I'm not totally sure I can mention by name has been a great example of that we, Becky had a management dinner with the management team almost a year ago today. And I think that led us, as we did more work, to realize that there was not just kind of an evolving AI infrastructure play with some of the largest hyperscalers in the market, but that also this company was growing through massive kind of cyclical headwinds in their telecom and mobile end markets, and that there was both a cyclical and a secular story at a reasonable valuation that was kind of being overlooked by the market.
Sort of fascinating.
And maybe I'll just layer, because I think there's also this fear that's out there in the market that AI is a bubble and that the large cloud companies are spending too much on infrastructure, and that as we go into 2025, we might see not only decelerating growth, but actually less investment because not every AI use case is working yet. That has also presented lots of opportunities for the fund because we see these stocks pull back 20%. And we feel like we have high conviction, so we try to use those opportunities to add.
Right. Okay. Fascinating. Kyle, there's a certain number of COVID darlings that I remember we spoke about years ago when all of that was happening and everyone's world was very sort of internal, and there were certain stocks that took off. They then kind of fell off a cliff. I'm curious about how some of those names, maybe when they fell off a cliff, looked attractive to you at that point, but they've come back a bit.
Yes. Well, yeah. And some of them, some of them, unfortunately, we were still with them as they came off the cliff. And that hurt very much at the time. These were secular growth stories that were experiencing their first real cycle. And like it was a learning to me, as I look for idiosyncratic growth stories that, you can forecast the earnings for on a 3 to 7 year view without taking a firm macro view.
Right.
And I try to find really sort of macro resilient companies. Otherwise, I don't think you're really a real growth company if everything just depends on the right set of macro variables. But as it turns out, like when the macro is strong enough, it matters to everyone. And there are some headwinds that become, too powerful to sort of power through. Some of those names now have, really been tested, have had to quickly change course to focusing on profitability rather than sort of growth in a zero interest rate environment. And some of them have really come through shining. And we almost, they don't at this point fit neatly into any of those three buckets, because I think that they have, they've been cyclically cyclically depressed. The growth rate may still not look very high on current year earnings, but if you followed them over the last couple of years, I think you can have a fair amount of conviction that growth rates will accelerate and profitability will be strong going forward. And I think these are the companies that have a good chance of becoming kind of benchmark long-term winners right in the center of that, earning their way into the center of that strong long-term grower bucket.
Okay, well,
I don't know if that's where you were going with that
yeah,
question.
no, that's exactly it. Becky, let's talk about some of those sort of long-term growers, and I guess just the ability, the strategy within the fund of what that sort of lets you, I guess, lean against as you look to some of these other ideas.
Yeah, I mean, so I think that we're looking all across the market for strong long-term growers. As Kyle said, we tend to look in places where either we think there's something that other people aren't paying attention to. That might be, a story like a Roku or an Uber. Those are two that struggled. Well, Roku really benefited from COVID and then struggled on the way out. Uber struggled in the early days of COVID and had to really get their act together on profitability and came out of COVID much stronger. And so, yeah, we try to step in when there's controversy, and especially when we can see line of sight, not only to the growth tailwinds, but also to profitability improving. And in both of those cases, both of those stocks, that's the case.
Right. Fantastic. What would you say is sort of unique right now? Like taking a look at, Kyle, some of the headwinds that are out there. We mentioned in the introduction that there's a lot of geopolitical. I mean, we're all pretty aware there's a big election coming up in your country. I mean, again, is there anything, is because the horizon is just further out there, you don't need to worry about it? What do you want investors to know about, times when it feels a bit tricky to be looking at markets right now?
Becky may have a different answer, could build on this one, but I think one thing that going back to the AI discussion we were having earlier, I think investors in our fund should know that in addition to the public equity investments that we have, we get a lot of insight from some of the private investments that we make
Really?
and that we've made in this space. And again, many of these are obviously smaller companies, but growing and backed by some of the much larger companies. And they are really helping, I think, give us a differentiated view on how the AI landscape is evolving and where, the value is going to go. I think just to take the question a little bit larger, I always say this in other contexts, but it's easy to identify a huge mega theme, and then it is tricky, and it's our job to figure out the best ways to invest in it, which are the business models that are really going to benefit from the theme. And I always use the wireless data example of wireless data was growing exponentially for years and years and years, and everyone thought, the carriers thought they'd make a lot of money selling data packets, and the equipment vendors thought they'd make a lot of money selling base stations, and the handset makers like Nokia and BlackBerry thought they'd make a lot of money selling handsets, and all of that was wrong. You had Apple and Google turned out to be the big winners, along with Facebook, even though they didn't have a mobile, and the tower companies, which just, everything goes on a tower company and they collect checks. And
telecom
AI is going to be very different from that, but I think that framework of realizing that just because you have the theme doesn't mean that's where the work begins. That's not where it stops. I've kind of gone on maybe a little bit of a tangent with your question, but I think that is something that I would want our investors to know and be aware of, and to know that is really where we spend a lot of time working and trying to find, the right business models to capitalize.
And to an extent that probably drowns out the noise. But yeah, Becky, maybe I'll ask you just to pick that up, just to sort of discuss a little bit on, you obviously clear out the noise, but it's something that investors think about too.
Yeah, of course. So we I think, try to be very aware of all of the dynamics that you just mentioned, the war, the election, all of the macro headwinds and tailwinds that are affecting the companies that we're invested in. But most of the time, I think that's an awareness at the portfolio level, and we don't really let these really high level ideas or issues affect our stock specific opinions. So I'll give you a couple examples. One would be solar. We're really excited about what can happen in solar over the next 5 to 10 years, but these companies will definitely be affected by the outcome of the election because one side politically is much more favorable towards solar. And so we're aware of the total solar bet that we have, and we try to just monitor that, knowing that the election is a risk. Another example would be in another part of energy. We think AI can be a big tailwind for some of these companies. So while, of course, we're going to watch the price of oil, and of course, we're going to be aware of what's going on in the Middle East, we think looking out with our time horizon, probably the most important thing is that we get the call on AI right. So definitely aware of the things that you're mentioning, but they're not the top drivers of the way that we position the fund.
Fantastic. Does the fund invest in industrials? It's kind of a new time with AI in the background for the industrial story. So yeah, I'll just put that too.
Yes, but I would also qualify it as like the single biggest bet, in industrials I think that we have isn't a real industrial. So it's cheating to use it as an example, but like Uber technically is classified as an industrial, which sometimes these classifications are less helpful than they should be. In terms of like the AI bet and finding other industrial plays around this mega theme, it's definitely something that the fund has invested in, has generated good returns from some of the investments we've made there. Going back to the idea of who has the right business models, where are you going to make the most money? We are, some of the names we have basically exited or reduced since then because they have, we have concerns about the length of the lead, ultimately the amount of competitiveness that some of the industrial companies will face as they go to market. But yeah, we're certainly like, we invest in industrials. It's an important vertical, and it has already been an important part of the market to look for ideas in both in generative AI and just in general.
And I wonder if I can sort of ask you how, again, you're going to be looking at things when they're probably being sold off, and we're having some of the mood swings in the markets we've had over the last couple of months. But again, does it take you back to sort of within the AI story, kind of the big old clunky companies that were like the old tech companies? I was just wondering if you can kind of dig into that story for us a little bit, Becky, because it does seem like they're part of a new story, but they're sort of antiquated names.
Yes, so I think it's a fair point. The large cap tech companies are hoping to participate in this generative AI wave. We think they are well positioned where we sit today. So I'd say a couple things. First, the biggest companies, the Metas, Alphabets, Google's, Amazon, Microsoft, are still growing at really healthy rates. I think in the most recent quarter, that top 7 group put up 11% revenue growth, which is actually faster than they did a couple years ago. Beyond what we all think of as, like, for example, Google's core business is search, Meta's core business is Facebook and Instagram. They've also all done really good jobs building out ancillary businesses. So Google has YouTube, Meta has WhatsApp, which they're not really monetizing yet. Amazon has their cloud business, and kind of the list goes on. So we think there are adjacencies for them. And then, like you asked, I mean, AI is an opportunity for them. They have enormous user bases. They're generating, I think it's so they're generating so much cash, but the stat I have in my mind is that the top 7 are going to spend $350 billion on R&D and CapEx this year. And just to put that in context, outside of those top 7, the average market cap for the S&P is 65 billion. So they're spending a multiple of the average market cap of the rest of the market. Just that's how big they are and how much cash they have. And then, of course, they have technology talent. So we do think they're well positioned to win in AI. And, we're seeing opportunities outside of just those big guys as well. Of
Right.
course, OpenAI is not in that group, and they're one of the winners. We have private investments that we think are doing great, other public companies, many in the semiconductor space that we're excited about. But yeah, I don't think I would characterize them as kind of the old guard, not yet. I think they're still really well positioned.
Okay, fantastic. Kyle, you mentioned that the way people buy and shop for cars is changing. Can you elaborate a little bit on how you're investing in that?
Yeah. So I'm not allowed to use company specific names all the time, but there is a hopefully becoming well-known e-commerce used car retailer that the fund had owned from 2017 to 2022, early 22, that we exited when we saw the used car market evaporating after them taking on a large amount of debt in order to buy a large amount of real estate and capacity that wouldn't be needed for years and years. As they have, that sort of near-death experience, I think, was the best thing that could have happened for this used car retailer. And what you're already seeing is their return to growth coming even as their competitors and peers in the space do not see anywhere near the same amount of growth. And we're already, 2 years into declining used car sales at a market level, and ASPs coming down after peaking in 21. And so I think what's interesting to think about is this goes back to how it's so interesting to see secular growth stories go through a cycle, because oftentimes the secular drivers are continuing to build quietly underneath, and you don't see them because of the cyclical headwinds. But the likelihood, the amount of research that consumers do online before buying a car or a used car continues to increase. The number of times that they visit a dealer before they buy a car continues to decrease because they've done all their work ahead of time. The amount of shopping that happens online, the amount of e-commerce generally continues to increase. So I think, what you're beginning to see is some of these e-commerce retailers that are taking on very kind of tricky parts of e-commerce, like used car sales, have outlived and outlasted all of their other potential disruptive competitors and are really separating from the pack. And you're beginning to see that same kind of difference between e-commerce and everyone else that you saw with Amazon many years ago and some of the other e-commerce winners.
That's fascinating. And I feel like there are shades of similarities in sort of the AI story that's unfolding right now. Becky, do you want to just close us out there a little bit on coming back to AI, the importance of it, and just the longer term, but also how you can kind of play in the cyclical stories for investors?
Definitely, yeah. So I think we are still optimistic that we're early days in this AI build out. As I started, as I said earlier in the call, it was 2 years ago that we all started talking about AI. It was only in the last 18 months that we started to see the explosive growth from companies like NVIDIA. And we think there's going to be a real maturation here as the big spenders in AI kind of solidify their strategies. We think the dollars are going to keep flowing, but there's probably more they can do the longer they're working on AI products and their infrastructure, trying to make it more efficient. So we feel like we're still very early days in this story. And then, as Kyle said, a lot of the semiconductor or AI infrastructure companies that the fund is invested in have this growth opportunity on that side of their business, but they also sell lots of other types of semiconductors, and many of those end markets have not been immune to the macro issues that we discussed. So we think we could see kind of continued growth in AI plus a bounce back in some of those cyclical parts of their businesses. And that seems like a good setup for the stocks.
Thank you for sharing that with us and sharing your time. Thank you so much, Becky and Kyle, for taking us through what you're doing, what you're seeing in the markets, and how you're investing on behalf of everyone joining here today. Have a good rest of your day.
Thanks for listening to us. Thanks for the time.
Thanks.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on Twitter. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.